So I'm going to talk about how the outlook for the public finance has changed and what Jeremy Hunt decided to do about it. And I'm going to highlight some of the key risks around the forecasts going forwards. And as Paul said, the starting point, and as I guess was widely expected, is that the OBR revised down its forecast for economic growth over the next few years. So these are the forecasts that were produced in March for steady, if not unspectacular, growth. And these are the forecasts that were presented yesterday for a recession and then stronger growth resuming, but still the economy running well below what was expected in March, a downgrade of about 4% in the middle of 2025. Things could be worse than that. There's clearly uncertainty about the path of the economy. And if you take the Bank of England's forecast produced just a couple of weeks ago, and you take their forecast produced on the idea that interest rates will follow market expectations, well, if that was the case, the downgrade to the OBR forecast would be more than twice what we saw yesterday. And even if we take the Bank of England's forecast that's predicated on the idea that interest rates remain constant rather than rising, you'd still see a bigger downgrade. So uncertainty around the OBR's forecast, and certainly we and Jeremy Hunt must hope that they are right and not the Bank of England, or even better, that things turn out better than what the OBR expects. Is it the case that the OBR is particularly optimistic? Well, actually, if you compare them to a wider set of forecasters, it's not clear it is the case. This shows the OBR's forecast alongside the Bank of England's, the IMF's, and the other independent forecasts that are surveyed by the Treasury. And it looks like the OBR, at least at the moment, is around the middle of the pack. So there's uncertainty on both sides. So what did this do to the outlook for government borrowing over the next few years? Well, these are the forecasts for borrowing that were produced in March, a deficit of over £120 billion in the last financial year, but falling down to kind of just over £30 billion by 26-27. But there's been lots of changes since. There's been changes to the economy, like I just showed you. The outlook for the economy is weaker. That adds to borrowing going forwards. So this shows how big those underlying changes since March have been. And actually a big driver of that has been an increase in the outlook for debt interest spending. That more than explains the increase in underlying change coming from underlying changes this year, and explains a very big chunk in future years. So let's look at the outlook for debt interest spending in a bit more detail. This chart is showing you how much the government's been spending on debt interest as a share of national income in each year going back. And if we take the March forecast, at the time it looked like there'd be a big spike in spending this year caused by higher inflation. But then if we look through that spike, spending would return back down to the low levels that we've been enjoying since 2000. So no evidence of a long-run problem from debt interest there. Unfortunately, that situation seems to have changed. The blue line here shows the OBR's forecast from yesterday. That spike in debt interest spending is now expected to be much bigger, a record level, debt interest spending at a level we've not seen for over 70 years, although I should add it wasn't uncommon before that. But more importantly, when you look through that peak, you see that debt interest spending falls, but it stabilizes at a level that's still pretty high by recent years. It's high by the standards that we've seen since 2000. So essentially a combination of all of that debt we've accumulated since 2008 and the fact that the outlook for interest rates is now higher than we've been used to over the last decade leaves debt interest spending higher. Now, here's an area where I think there's actually some cause for optimism in the OBR's forecast. While they've revised up their outlook for debt interest spending, I think it's possible that debt interest spending won't rise as sharply as they expect. So these are the forecasts that were produced by the OBR in March for debt interest spending. And these are the forecasts that they presented us with yesterday. So you can see in 26-27, they were projecting that debt interest spending will now be £95 billion, double the 47 they were predicting back in March. Now, these forecasts for debt interest spending that the OBR produce take market expectations of what interest rates will be. That's one approach. An alternative might be to say, what are independent forecasters saying about where they think interest rates are going? And let's use that when we're trying to project debt interest spending. So if we take the average of independent forecasters' expectations, it is the case they think that interest rates will be a lot higher than what was expected by the OBR back in March, but it's actually lower than current market expectations. So while there'd still be a big increase in debt interest spending relative to March, it wouldn't be as big as the OBR expects. So in the coming financial year, debt interest spending would end up about £9 billion lower than the OBR expectation, still £50 billion more than they thought back in March. But in 26-27, the increase would be reduced by £17 billion. So this is an area of the forecast where we must very much hope that things could turn out better than the OBR expects. As Paul said, there was also another change in the forecast that looked quite puzzling and concerning, and that relates to one part of the working age benefits bill. The OBR revised up by £7.5 billion how much it expects to spend on disability and other health-related benefits in 26-27, and that's over and above the upwards revision it made because of higher inflation. So this is coming from a huge increase in the numbers that the OBR expects to be receiving these benefits. Previously expected 8.2 million people to be receiving these benefits in 26-27. That was just in March. It now expects 9.3 million. So a 1.1 million increase in its forecast over just a 8-month period. Now, there's relatively limited information provided by the OBR about this. We're going to follow up and try and find out if there's more on what's going on. But our reading of the evidence suggests that it's driven mostly by the benefits which are available to those who are out of work because of having a work-limiting health issue. So it's not the benefits, we think, that are there for people who are in or out of work who are getting support to help them with the extra costs of that disability. We think it's the out-of-work benefits bill, the incapacity benefits, that is driving it. I think it's also worth noting that the autumn statement also said that for people who are on these out-of-work incapacity benefits who haven't yet moved across to universal credit, they're going to delay moving them across until 2028. That's despite the fact just last April, the government committed to having them all moved over by the end of 2024. Now, we don't know, but we wonder if there's some connection with the increase in caseloads. But there could be another explanation. It could be that by pushing it to 2028, what the government's trying to do is just push the costs of having to do this change until after the end of the forecast horizon. And we note that the government is also trying to merge pension credit with pensioner housing benefit. And the autumn statement yesterday also announced that that is also going to be delayed until 2028, which will also have the impact of reducing public spending throughout the forecast horizon. Let's go back to the outlook for borrowing. The other thing that happened between March and before yesterday's autumn statement is we had a whole load of policy changes. So we had the energy price guarantee announced by Liz Truss. We also had things like the abolition of the health and social care levy. So these also acted to increase the outlook for borrowing. So what that line shows you on this chart now is what the outlook for borrowing would have been had Jeremy Hunt stood up yesterday and said, actually, I'm not going to implement any new measures. I'm just going to let borrowing go along this path. I'm going to allow the underlying changes and the policy measures announced since March to push borrowing up. And you can see that would be quite a substantial increase in borrowing. The difference between the March forecast and that pre-autumn statement forecast in the current financial year is about £80 billion. And in the last year, in 26-27, it's running at about £90 billion. So let's look at that increase in borrowing. That's shown by these dots on this chart. This is the increase that would have happened had Jeremy Hunt not done anything yesterday. And we can answer the question, how much has he decided to try and offset that increase in borrowing with new spending cuts or new tax rises? And that's shown by these bars. And the answer for the current Parliament is he's really not trying to do very much to offset that increase in borrowing. There could be good economic reasons for that, but it does mean we'll be borrowing a lot more in the next couple of financial years. Beyond that, there is a fiscal consolidation plan that starts to get into action. But even in 26-27, you can see that the new tax rises and spending cuts are offsetting less than half of the increase in borrowing that we've seen since March. We can also break those measures down into whether they are permanent spending cuts, whether they're temporary tax rises, the energy and the windfall tax on energy companies, or whether they are permanent tax rises. And on our calculations, the new tax rises we heard about yesterday are explaining about 40% of the planned fiscal tightening in 27-28. So 40% from tax rises, 60% from spending cuts. And we can compare that to previous consolidations. George Osborne, when he was Chancellor, set out to try and achieve a fiscal consolidation that was 80% spending cuts and 20% tax rises. So Jeremy Hunt's plan is more tax heavy, less spending heavy than that. But when Ken Clarke in 1993 was trying to fix the public finances, our calculations suggest that he went for an approach that was roughly 50-50 tax rises and spending cuts. So one that was more tax heavy than what Jeremy Hunt is now trying to do. So where does this leave taxes as a share of national income in the United Kingdom? Well, if we go back to March, these were the forecasts for tax as a share of GDP over time. You can see that they were set to rise and reach levels that we hadn't actually sustained since the 1950s. After the mini budget, Chancellor Kwasi Kwarteng was still seeing tax as a share of national income at pretty high levels by UK standards, but he had them on a downwards path because of that big package of tax cuts that he announced in his mini budget. Jeremy Hunt is much more than the reverse to that. The new tax rises means that the taxes as a share of national income are set to grow well above what was expected even in March and be well above anything that the UK economy has sustained in its history. So taxes as a share of national income, high by UK historical standards. It's worth saying that there are other successful economies in Western Europe and Scandinavia that sustain higher tax burdens than this. So government borrowing up in the near term, where does this leave the path for government debt? Well, back in March, when Rishi Sunak was Chancellor, he wanted to have debt falling as a share of GDP 3 years out. And he set out some forecasts that showed that this was going to be achieved, but only just. He didn't really have debt on a decisively falling path. It was gradually falling. There was a margin of error, some headroom he had of about £28 billion. That sounds like a huge sum of money, but in the context of trying to forecast the change in debt 3 years out, it's really not a big margin. Where are we now? Well, the extra borrowing over the next couple of years pushes debt up. And at the end of the forecast horizon, when Jeremy Hunt is now trying to make sure debt is falling, he's trying to get it falling in 5 years' time, not in 3 years' time, he's just about got it falling. Believe me, that line is coming down, even though you can barely see it. He has a headroom of £9 billion. That's absolutely tiny. It suggests that on current policy settings, there's roughly a 50-50 chance on whether debt will actually be falling in 27, 28. And there are some big risks around this forecast. One set of risks relate to the revenue side. The current baseline for forecasts assume that each April, the rate of fuel duties will go up in line with the RPI. And that hasn't happened since 2011. Moreover, they assume that the 5p cut to fuel duty that's currently in place will be allowed to expire in April. So if that all goes ahead, that implies that fuel duties would go up by a whopping 23% in April. I predict that's not going to happen. If we freeze rates again, it will cost about £6 billion in 23-24. As Stuart will talk about, we've also decided to freeze many allowances in the tax system, and in particular, the personal allowance and income tax is set to be frozen for 6 years. In the last year of the forecast horizon, that raises about £1.3 billion. And I think there's a genuine question about whether that's credible. In my lifetime, the maximum freeze that we have managed is 2 years. So it'll be interesting to see whether a 6-year freeze really does happen. So to conclude, there's been a big deterioration in the outlook for the public finances since March due to a much weaker economic outlook. And much of that deterioration is actually explained by higher interest rates pushing up debt interest spending. And actually, that increase in debt interest spending could be smaller than what the OBR expects. There is some room for optimism there, I think. The measures outlined by Jeremy Hunt in the autumn statement only counteract a small share of that deterioration in the public finances. And of the measures he set out, we reckon that tax rises are explaining about 40% of the tightening, spending cuts about 60%. There are risks to this. Some of the policy risks are, will taxes as a share of national income really be sustained at 37% of national income? There's also risks on the spending side. Yesterday, Jeremy Hunt trimmed his planned level of spending in 27-28 by £30 billion. That raises the question of whether the spending plans can really be kept to, and that's something that Ben Zaranko will now address in his presentation. Thank you.